Hello, students. Welcome to the massive open online course on money and financial markets. Hope you remember that in one of our previous lectures, we have discussed the basic functions of a central bank. While discussing the basic functions of a central bank, we primarily emphasized on Indian Central Bank, namely Reserve Bank of India. Now, on this background, natural progress or development of the course calls for explaining some typical particular country-specific policies that have been adopted by or initiated by the central bank. Central bank, in case of India, it is Reserve Bank of India. So there are vast policies or various policies that have been adopted by this Reserve Bank of India during the last 60 years, 50 years or so. So it is not very easy to discuss all these policies in one lecture. So we will try to divide the various instruments of policies adopted by Reserve Bank of India in two modules or two lectures. Today we will have our first module. This is Instruments of Monetary Policy 1. The primary motive of this module is to make you aware of few things. You can call it, this is the broad outline of today's lecture. As like any other lecture, this module starts with a very brief introduction of the monetary policies, and then we will talk about the difference between monetary policy and another set of policy which is termed as fiscal policy. I'll explain it later. And then I will go on elaborating much on monetary policy. And while discussing monetary policies, I'll also try to bring in some fiscal policies and try to look at how they are different from the monetary policies and what are the motives of fiscal policy and how they are going to interact with each other to achieve a desired outcome. And then, of course, we will wrap up this lecture and give you the takeaways, the prime messages of this talk. Now, as I said that, the introductory part, one should remember that our focus would be on the difference between monetary and fiscal policy and the various approaches. RBI essentially uses different monetary instruments for the stability of the banking system and the economy as a whole. On the other hand, these are the monetary policies. On the other hand, there are a group of policies, set of policies that have been implemented not by the Reserve Bank of India, but by a sort of counterpart of Reserve Bank of India or the controlling authority of the country per se. This is the Government of India. This is called fiscal policy. We will explain it in a moment. Sometimes these instruments are targeted for one issue at a time, and sometimes it is multiple. So what is the main issue or main motive of monetary policy? That will be discussed in our next slides. But the bottom line is that the main target is to do a kind of balancing act. Balancing act means it may be growth, it may be development, but we should not ignore the possibility and the perils of distributional issues. So RBI also takes care of all these issues in tandem with the fiscal policies implemented by the Government of India. Now, for example, if the RBI wants to lower inflation in India, but it also wants to keep the employment rate stable at the current rate. Why I'm saying this example? Inflation or having a stable price level in the economy should be the prime target of the central bank of any country. But we know that in macroeconomics, there is a very popular curve called Phillips curve. This Phillips curve essentially focuses on the inverse relationship between price level or inflation and the unemployment. So you cannot afford to have higher inflation. At the same time, you can not afford to have much more unemployment either. So essentially, a country, the economy, or the central bank should have a balance of these two things. Now, the monetary and fiscal policies are both designed to achieve particularly economic stability. The officials responsible for them approach that the goal on different fronts. The main goal is the economic stability. On the one hand, monetary policy refers to the supply of money, and the amount there is to spend. So, how much money is there and how to spend this? On the other hand, fiscal policy implies the budget of the economy and how the money is going to be spent. So, monetary policy looks at the supply and then the amount of money I have to do this thing. And the fiscal policy focuses on how to do this thing, how this money is going to be spent. So, monetary policy involves manipulating interest rates, and the money supply is the job of the central bank of any country. So, this is done by the central bank. In India, it is done by the Reserve Bank of India. On the other hand, fiscal policy determines how the existing supply of money is going to be spent. This is essentially not the responsibility of the central bank of any country. This is the responsibility of the government. And the government uses various tax policies and spending legislation to achieve economic stability in our country. The Reserve Bank of India controls the money supply by a few things. One is by buying or selling securities in the open market, changing reserve requirements for commercial banks, and raising or lowering the interest rates, known as the discount rate. And by increasing the money supply, the RBI often lowers the interest rate, and lowering the interest rate essentially boils down to the fact that the borrowing cost goes down. And here two important instruments that have been popularly used by Reserve Bank of India to control the money supply, and these are considered as one of the two most important monetary policies is repo rate. One is called repo rate, the other is called bank rate. Now, for repo rate and bank rate, we can discuss in more detail, but before that, I should say a few things regarding other issues. Whenever the government targets, or the Reserve Bank of India targets interest rate, RBI essentially puts downward pressure on the inflation and provides a needed boost during the recession. Why? Because during recession, the primary target should be to enhance production and generating employment. That can be done by lowering the interest rate. And that should be done. This initiative should be taken definitely by the Central Bank of India, and here it is RBI. So in doing this thing, RBI may have some pros and cons. So among the pros, as monetary policies implemented by the central bank, these are very quickly implemented whenever necessary. But in case of fiscal policy, that cannot be done. So the central banks should actually play a neutral role here. This should not be controlled by the government. Because government is elected government, it may have some other motives, but the RBI should not be bothered with those things. On the other part, the negative side, the results tend to lag implementation. It may take some time. So there is always a risk that in between these two things, there may be something like more inflation or less inflation. If it is more inflation, it is called hyperinflation. So essentially the problem is how to balance all these issues. Now, just like any other policies, monetary policy and fiscal policy both could be, expansionary and contractionary. Expansionary policies means what to do to expand the activities of the economy, and what to do in case of requirement, how to contract the economic activities. Contraction of economic activities may lead to contraction of output, contraction of employment, and etc. Now, here I'm not going to focus much on other things. Let me go to typically the instruments of monetary policies. As I said, the central banks purchase or sell. This is the thing that I mentioned before. I hope you remember that the sale of bonds in the open market. And these are essentially called security or the treasury bills. So when RBI introduces these bills, then RBI can draw money from the open market or can inject money in the open market. So essentially RBI, what does it do? This actually increases or decreases the money supply, supplied money in the economy that is going to be circulated among the banks and the common people. So in doing so, just like other commercial banks, RBI also keeps a kind of bank account. This is called double entry bookkeeping. This is called a T account, assets and liabilities. This is very apparent, and if you just look at the slides and points, you'd be able to understand. So I'm not going to discuss this thing here. Now, These are certain things that probably you know, but I want to mention very briefly. One is statutory liquidity ratio. The statutory liquidity ratio is one important parameter of the banking system, particularly for central bank. This is the ratio of assets or money that a bank need to keep intact in the banks. Bank means I am referring to the commercial banks. If the commercial banks want to do business of say 10,000 rupees, there could be a certain ratio, a certain amount that has to be kept aside, that cannot be put in the circulation immediately. It is a kind of buffer in case of emergency that may be used. Right now, in India, there is a range of selective statutory liquidity ratio. The range is 40%, the upper limit, and the lower limit, 0, none. But the current statutory liquidity ratio is 18%. So this statutory liquidity ratio actually helps the government to sell its securities, debt instruments to banks, unlike CRR. Then the question is, what is CRR? CRR is the cash reserve ratio. The cash reserve ratio, students, I mentioned this thing while discussing functions of central bank. If a commercial bank wants to do business, then out of the total money deposited in the commercial banks, this money is being deposited by common people like us. Out of the money deposited, a certain fraction is to be kept with the Reserve Bank of India. Again, this is a kind of buffer stock. In case of any emergency, RBI may come up to bail out those banks, RBI may come up to bail out the economic problems. So it ensures that the security of the amount in case of any emergency, as I just mentioned, the cash is readily available when customers want their deposits back. It helps in keeping the inflation under control. During a threat of high inflation, RBI essentially increases the cash reserve ratio. Why? Increasing the cash reserve ratio means you withdraw the money from the circulation. Then if you withdraw the money from circulation, total money supply in the economy is going to go down. If the money supply goes down, then the people will demand less goods and services produced. If the people demand less goods and services produced, there is a tendency that the price level should go down. So in order to curb or control inflation, increasing CRR is a very popular measure. In India, of course, it will have some effect on employment, but that is not altogether a different issue. But at this moment, this is not the prime concern of the government. But at this moment, the CRR, the current cash reserve ratio in India, is set at 4%, which was in the month of May 4.5%. So Reserve Bank of India, I'm not saying that they play around this thing, but they adjust this CRR and statutory liquidity ratio to bring stability in the economic system. Now, you remember that I mentioned about one rate. This is called bank rate. I also mentioned about another rate. This is called repo rate or reverse repo rate. Now, first of all, let me just come to this bank rate. Bank rate is the rate at which Reserve Bank of India actually lends money to the commercial bank. So essentially, commercial banks may borrow money from the Reserve Bank of India. But whenever commercial banks are borrowing money from Reserve Bank of India, they need to pay some interest rate. What is that? This is called bank rate. So often people argue that bank rate is a sort of, short-term or long-term kind of solution to any crisis. But I don't want to tag this thing bank rate or repo rate or reverse repo rate with this short-term or long-term. Essentially, bank rate is the rate at which commercial bank gets loans from the parent body. And who is the parent body here? Central Bank of any country. And in case of India, it is the Reserve Bank. So Reserve Bank can also change bank rate to control the money supply of the system or in the economy. And also there is a liquidity adjustment facility. I'm not focusing much on this liquidity adjustment facility, but I'm jumping to the repo rate, and the corresponding rate is reverse repo rate. Just like bank rate is the interest rate for loan to commercial banks. And repo rate, just you expand the word repo, this is called repurchase rate. So bank can issue securities, bank can issue kind of papers, and if the banks means Reserve Bank of India, wants to draw some money from circulation, they sell this paper sell this bond or securities to the commercial banks with an agreement that, with a commitment that if needed, then the Reserve Bank of India will again repurchase that bond from the commercial banks. From here the name comes, repurchase rate, repo rate. So when the Reserve Bank of India is selling this paper to the commercial bank in exchange of that paper giving money to the Reserve Bank of India. Reserve Bank of India is not actually injecting money to the system. Instead of that, it is withdrawing money from the system. So the money supply goes down. And whenever needed, when the commercial bank says that now you please buy back this security paper from me, I want money. So the commercial banks initially gave money to the central bank, Reserve Bank of India, and the Reserve Bank of India committed that this would be the interest rate that you will get whenever you give me back this piece of paper. So at the rate which is committed, which is promised by the Reserve Bank of India, this is called repo rate. And when the reverse takes place, when again the commercial banks buys back or gets back the paper from the Reserve Bank of India, this is called reverse repo rate, reverse repurchase rate for securities and bonds issued by the central bank. Here in case of India, it is RBI. I'm saying it again and again. It is Reserve Bank of India. So this repurchase rate also targets to control money supply in the economy. So this is the thing I have explained, so I'm not going to repeat the whole thing again. Just you look at this slide and I'm pretty sure that you will be able to understand the whole thing. And now coming to the marginal standing facility rate, it does not require much elaboration. But I want to mention 2 or 3 points here. It is a window for banks to borrow from Reserve Bank of India in an emergency situation with interbank liquidity dries up completely. When this interbank liquidity goes down, then this is used, and it is a short-run arrangement as banks generally do not run out of liquidity for a long time because all the banks are going bankrupt at the same time. This is not quite normal. So, but in case it happens, then what would be the solution? The solution is the marginal standing facility rate, but this is not used usually. It is not needed at all. But this part is very important. This is credit authorization scheme of the central bank. And this was introduced in 1965. The main target is again, this regulating the credit and controlling the inflation, to enforce financial discipline in the system, particularly for large borrowers. There is a tendency, particularly in developing countries like us, that we may have money laundering case and the credit defaulters. So how to control these large borrowers? This has been mentioned here, and this is used. This has been used by the central bank. So to ensure credit, it is used for productive purpose that have been specific plans that have specific plans for the development motive of the government. So essentially, it also monitors how the development plans of an economy or the budget forecasting of the economy is going to be achieved. That gets some kind of support from the Reserve Bank of India. And to ensure large borrowers do not monopolize scarce bank credit. There's a tendency that if I'm the biggest borrower, then I may control the banking system of a particular bank. So that should not be the ideal case. This is not a healthy practice in case of any country, and particularly when the country is plagued with monetary issues, country is plagued with poverty and some poor people. Now, another thing apart from this quantitative policies taken by the Reserve Bank of India, some moral suasion. This moral suasion, central bank can pursue the customers, pursue the commercial banks to do good for the economy. So this is essentially moral suasion. We can call it a qualitative policy, qualitative monetary policy. But here it is nothing to do with the rates, with the exact amount of supply, absolute values, but it is a kind of, dialogue, conversation to convince others, please do this thing and please do not do this thing. Now, we are almost at the end of today's module. So, as usual, we need to summarize the whole thing and we need to tell you what are the takeaways. So, the first one is that there are monetary policies and fiscal policies, and both are targeting for economic stability of an economy. But the officials responsible for monetary policy is Reserve Bank of India, and the office responsible for fiscal policy is the Government of India. RBI uses various monetary policies, monetary instruments for the stability of the economy as a whole. But I will come to one point at the end of this takeaways, which I intentionally overlooked because I know that this will create room for a next lecture. Just hold on for a moment. So using different instruments, sometimes it targets high inflation level. As I mentioned that the RBI uses reverse repo rate, and cash reserve ratio along with statutory liquidity ratio to control money supply. And by tweaking these instruments, RBI can also increase investment and hence employment in the economy. My point is essentially associated with this point. I'll come to that. The RBI also monitors the entire banking system, which is very important in general, and guides and advises commercial and cooperative banks for the benefit of the banks and for the economy. Now going back to point number 4. So I mentioned that RBI can also increase investment. I hope you remember that while discussing the whole thing, I mentioned somewhere that RBI often targets to adjust the rate of interest. If the rate of interest goes down, it will have a direct impact on the investment. Why? Because there is a possibility of foreign direct investment or foreign portfolio investment. When rate of interest goes down in an economy, the foreign investors do not find it very lucrative to invest money here. So if they do not invest money here, essentially our currency or money becomes weaker. If the money becomes weak, essentially the value of rupee goes down. It has a very serious impact and significant impact because the value of rupee is going down means it is becoming weak and the exchange rate of the economy is changing in such a way that it is going to influence export and import. And you know that in this world where the globalization is taking place, we cannot think of anything without being integrated with others, with other countries, with the rest of the world. So exchange rate is a very important phenomenon in this regard. So when exchange rate goes down, it essentially has a serious positive effect. What is the positive effect? Export goes up. Why? Because the value of money goes down means, say the price of tea is rupees 100. And when the value of money goes down, initially maybe $1 gives 100 rupees. Now $1 gives 150 rupees because money is weak. If the money is weak, a US citizen is now by spending rupees $1, spending only $1 can buy tea of rupees 150. Previously, they could buy tea of rupees 100. So naturally, they are getting more tea. So they will try to buy more tea. So naturally, our export increases, our export income goes up. On the other hand, import goes down. So when import goes down, export goes up, means employment must increase. So it might be that the rate of interest is going down. It is actually depressing foreign direct investment, but in the long run, it will have serious positive employment effect. So RBI can play a very critical and crucial role in handling inflation and unemployment through changing interest rate. Students, I hope you have understood the point, and this is a very interesting point. I will try to relate this point with other instruments of monetary policies in our next lecture. Thank you very much.